Chinese and Hong Kong equity market is now very cheap, but the economic outlook is quite uncertain. So what do you think investors should do? Should they maybe bottom fishing or maybe just stay away from the market?
I think we just talked a little bit about some of the industry that are going to benefit from industrial policies, and so we like to pay a reasonable price for a little bit of growth, but this with the tailwind of the industrial policy.
Hi, welcome back to the Curious Investor series, the show where we break down complex financial topics and help you make informed investment decisions. Today, I have invited our strategist, Redmond, here. Redmond, welcome back.
Hi, Lana. Thanks for having me again.
Happy New Year.
Yeah, Happy New Year to you too. I think, talking about the Q1 outlook.
Yeah.
I think that it's going to be more bumpy, and the outlook probably will be not as bright as last year. And I think for two reasons. I mean, especially the first quarter, we probably eventually will be seeing some of those releases in the U.S. economy, and it's emerging. And also in Europe, it's quite the economy will be also quite weak. So that's number one. And so of course that will also affect the company earnings, so that will have some impact on the stock prices. And then it's also going forward, I think the investors still look through. There will be a lot of political uncertainties globally, as also in the US, and with the presidential election is coming up in November. And this year it seems it's quite, so there's a lot of unknown uncertainties, and many things can happen. And so that will be certain, increase the kind of risk and demand for more risk premium for in the financial market.
So the central bank is about to cut rates. Will that help the equity market?
Yeah, you're right. I mean, we think the Federal Reserve probably will start cutting rates, maybe even as soon as March. And the European Central Bank, the ECB, and also the Bank of England probably will also cut rates very soon. So yes, that will give some support to the market. You're right. But at the same time, it's when investors start thinking about why the central bank cutting rates, probably we are seeing emerge, as we discussed, we are seeing some emerging signs of weaknesses in the economy, and about also the concern about earnings. So we are not saying that the market will collapse or whatever, but there will be some weaknesses, and especially there may also be some rotation out of those, some of the sectors which performed very well last year probably will be we're seeing a lot of profit taking, and also there will be some rotation to maybe more defensive as the economic outlook become less promising.
About what you mentioned before, I would think that AI is still growing quite fast. And would it help the growth of those big tech companies? And also, just like in 2023, will it also help to propel the NASDAQ?
Yeah, I think AI in the very long term, we're still quite positive on AI. I think that's very promising. But just like in all those previous, new technology development, like electricity or PC, internet, initially, I mean, this investor become very optimistic. And unfortunately, the productivity gain and also the ability of company to monetize from the new technologies will take years. So I mean, it makes sense. Last year in 2023. We have investors put a lot of money to work on some of those company, what we call those company, they sell picks and shovels in the gold rush, i.e. providing the microchips and providing the infrastructure for the development, the new technology, for development of AI, and that worked out very well. But with the rise in valuation, and also in the very high revenue guidance from company like NVIDIA and so on, and for those high growth in revenue and to continue, and will be quite challenging. And so so we think that is probably is the time to hedge some of the risk there, or maybe to reduce some of the bet there. But having said that, we still positive AI in the longer term. But I think we just think that in the near term, I mean, probably will look for some other opportunity, even along the AI value chain.
What are those AI value chain that you were talking about?
Yeah, I think initially, in like all the technology, initially you have the innovation and of the new technology. So sometimes you don't know which one actually will be the winner. So let's like last year, people invested in, like NVIDIA is selling microchips to other company who actually developing AI and so on. So like in the gold rush in California, and that if you sell shovels and picks and those tools, and you make a lot of money, even though whoever you wanted to bet on who actually can find the gold. But this year's probably is probably is going to more on the implementation and also monetization. So probably looking at some of those company industry that actually can have to have application, and also I think now is now some emerging trend in investment opportunity in the AI interface, and also some of those application in digital marketing, or some of the also, and these are areas. So maybe more focusing on some of those applications and implementations, and that would be something interesting. And also one theme we like very much is cybersecurity. I mean, we like cybersecurity for a while already for the reason about the geopolitics and so on. But now if the AI, in fact, that will actually also help the growth in cyber demand for cybersecurity with the development of AI, then you need more security to defend. So yeah, I think cybersecurity is one of the good themes to look at also for this year.
So, what are other industries that you like?
Yeah, and we like commodities related industries, and we think that despite, I mean, it's quite difficult to say whether the economy actually how far they will slow down, or whether there is a soft landing or hard landing, even though we tend to think that the economy will slow down quicker than the market expect. But we think that the commodities industries and the commodity sectors is actually in a more super cycle. So small, medium to longer term, we still like to build our positions in commodities, even though they did not do as well last year. But I mean, it's not with the. But this year, we think that is where they probably tend to outperform, and we would like to invest in that area. And also defense, especially in European defense, I think we like that sector for a while, and we continue to like this. And because it's all the government still will be spending a lot on defense, and so that will also help the sales growth. And other things like green transformation and mining, and because we like a lot of those green metals like copper, aluminum, so the related mining company, and also we like gold mining, and we also like energy and sectors. So those are actually we like more on we call the tangible stuff industries, and so yeah, that's the areas we like.
So for this coming year, should we still focus on US markets, or are there any other markets that we should look at?
That's a very good question. Last year, definitely US did very well, but this year we think that it may be worthwhile to diversify into other market. And okay, we said the European economy and the UK economy are not doing that well, but I mean they have come down a lot. Those are, I mean, it's in terms of valuation, relative valuation versus the US. We think that they are relatively cheaper. And also one good thing is we just said is we like those tangible industry that produce tangible products like industrial manufacturing, mining, energies, and defense, and so on. And you actually have some quite good quality company in the European and the UK market and in those sectors. So yeah, I mean, we think that it's worthwhile to diversify and look at some of the opportunities in the European and UK market. And yeah, I think, and back to this part of the world, probably some of those, ASEAN countries or even Japan still interesting.
What about China?
China is, I think, is a lot of uncertainty at the moment. The investment sentiment is still very low, as you can see, and without any catalyst, is in the near term. It's difficult to say when it will turn around. But we have a few important meetings coming up, like the third plenum in China, and that is going to decide on development strategy for the country for the next 5 years. So probably that will be some, so we need to hear from that to be really clear. But having said that, I think there's one thing very sure that the Chinese authorities are pushing some industrial policies, whether that's, whether the overall economy, how quick you can recover and so on, but they still will do a lot in the industrial policy. So we can look at some of those companies which are going to benefit from this kind of industrial policies, like some of the companies in the advanced manufacturing or 5G, and also in it's mainly on the technology hardware rather than the consumer-facing e-commerce company. Those are, because it's the e-commerce company and so on, they are applying some of the existing technologies to the large market in China, but that market has become quite saturated at the moment, and they are not really allowed to expand into some of the new areas. So for the hardware, technology hardware, probably they tend to benefit more from the government policies. And you can see actually from the lending policies, you can see the government has been telling banks to lend to many of those industry that actually is in the technology sector, especially in building hardware and so on. So that's one thing. The second one, I think green transformation. I think that's still a theme China is very keen, and you probably have the EV batteries or other, and also is electricity grid. I mean, all those is it's all China is pushing for using more electricity, using less coal, and also in some of those new energies and so on. Those are still I think it's quite promising sectors. But of course, we have to be. I think this year one thing I need to remind investors is I think valuation is we have to pay quite a lot attention to valuations when we see, like, even though we like certain industries, we still have to be very careful to not to overpay for those companies, because China is recovering, the growth is coming back, but it's not a high growth. So if you are not talking about a high growth economy, high growth industries, and valuation become very important, because you are relying on pretty much the current level of cash flow, and with a little bit of growth, that is good. You don't want to overpay it. Rather than when in high growth era, I mean, you are relying the performance relying on really on your expectation of growth in the future, so you can actually pay for a high multiple. So yeah, I think those are key observations for this year.
Last year, our Q4 theme was to buy bonds. So this quarter, in Q1, do you think it's still a good idea to stay long in bonds?
I think, in the portfolio, it's still good to have bonds. Yeah, still definitely. Bond probably will not make you a lot of money this quarter, but they are good to have because, number one, the yield are still quite good and can enhance the yield of the portfolio. And we still think that there's some opportunities for price appreciation. I mean, it's because of, as we discussed earlier, the Fed is going to cut interest rate, and probably March, or if not, just a little bit later. And that will usually, I mean, if you look back to the last 10 or 12 easing cycle, the 12 easing cycle since 1970, and every time in the 3 months leading up to the first rate cut by the Fed, bond yield came down, so quite a bit. Yeah, so every single time in the last 12 times of easing cycle. And so now, if we think that the Fed is going to cut rates in March or a little bit later, so it's around 3 or 4 months time, or even less than 3 months. So bond is still well supported, but investor probably need to be more careful after that, because it's when because it's inflation. Yeah, I mean, at the moment, inflation on the 3 month, 6 month momentum is coming down. That is good sign for bond. So at the moment, it's good, but going into the second half, the inflation may not be able to continue to fall. So you go in the second half, a bond can be a little bit more bumpy again. And also historically, when the Fed, in the next after the first rate cut, and then the return, the outcome of bond investment is less certain, and something a little bit more mixed. And so I think, yeah, I mean, next 3-4 months still have a good time to stay in bond and good for the portfolio. And one more thing is last week we have the FOMC minutes, and one of the key message we pick up from there is several participants of the FOMC meeting. They actually say the Fed should start looking at talking about what factors will the Fed should consider to slow down the pace of quantitative tightening. That means it's now, at the moment the Fed's doing quantitative tightening. That means they are reducing the balance sheet, let the bond security holding to mature, and that would be taking the liquidity from the market. But now they are, I think, thinking about maybe they should start considering maybe they should slow down their pace. That is good for bond because that means that they will continue to roll over or to keep the large balance sheet. That would be helping, so supporting the bond market. So those few things together probably is still good to have some bond in the portfolio.
The Chinese and Hong Kong equity market is now very cheap, but the economic outlook is quite uncertain. So what do you think investors should do? Should they maybe bottom fishing or maybe just stay away from the market?
I think we just talked a little bit about some of the industry that are going to benefit from industrial policies. And, so we like to pay a reasonable price for a little bit of growth, but is with the tailwind of the industrial policies. But for some of the overall market, and including some of those, we got actually asked also by other investors about those mega cap internet companies. I mean, they look cheap, but at the same time, they may still can get a little bit cheaper, because I think we have to be very opportunistic. We don't really want to be jump all in, because they are cheap historically. They may be cheap if you compare that with the technology company in the US. But if you look at them as a consumer product company, because it's now, some of them actually is more like consumer facing, as we discussed. They are just applying the technology, but it's actually addressing a consumer market. And that one's not growing that very fast. And also the market quite saturated, and it's very competitive under pricing pressure. But they are very strong. They have strong balance sheet. I mean, they are a good company. So I think that would be a price that they look interesting. But I would say they just, we just cannot look at the historical valuation and say that now they are very cheap. So I mean, and then it's probably for some of the trade investors, they are more trader type, and that probably because they're high beta and very liquid. So as we just mentioned, that's we have the third panel and other meetings coming up, and also the 2 sessions later on in March. And so that probably will create some volatility in the market. And this kind of company also very liquid, high beta, is very good trading opportunities. As a trading kind of insurance. But I mean, if for slightly longer term, medium to longer term, we would like to invest some of those industries really more on the hardware technologies, and rather than the consumer-facing e-commerce company.
Redmond, thank you for sharing with us Saxo's Q1 outlook. And stay tuned for more videos, and we will help you here to make more informed investment decisions.
Thank you.